For most of modern U.S. economic history, truly explosive growth has come from a small number of transformative forces. Electrification, mass production, computers, and the internet each reshaped productivity in ways that lifted entire industries at once. Today, artificial intelligence is being discussed in similar terms. Business leaders, investors, and policymakers are asking whether AI could become the next engine of rapid economic expansion, or whether its impact will be more gradual and uneven. The answer matters because it shapes expectations for growth, wages, inflation, and competitiveness across the U.S. economy. The argument that AI could trigger explosive growth starts with productivity. Productivity growth has been relatively modest in the U.S. for years, even as technology advances. AI offers a way to automate tasks, accelerate decision-making, and reduce inefficiencies across a wide range of industries. Unlike past tools that were limited to specific sectors, AI has the potential to influence everything from logistics and manufacturing to finance, healthcare, and professional services. If productivity rises meaningfully across multiple sectors at the same time, overall economic growth could accelerate. Another reason AI is seen as a potential growth catalyst is its ability to scale knowledge work. In the past, productivity gains were often concentrated in physical processes. AI, however, can assist with analysis, pattern recognition, forecasting, and content generation. This allows highly skilled workers to produce more output without proportionally increasing labor. In an economy facing demographic constraints and labor shortages, this kind of scaling is especially attractive. Investment patterns also support the growth narrative. U.S. companies are pouring capital into AI infrastructure, including data centers, specialized chips, cloud capacity, and software platforms. These investments stimulate economic activity directly through construction, manufacturing, and services, and indirectly by enabling new capabilities. Large-scale capital spending can create multiplier effects throughout the economy, supporting jobs and demand beyond the tech sector itself. AI's potential impact on business formation is another factor. Lower barriers to certain tasks could allow smaller firms and startups to compete more effectively with large incumbents. If AI reduces the cost of research, marketing, operations, and customer support, entrepreneurship could increase. A more dynamic business environment often leads to faster innovation and growth at the macro level. However, the case for explosive growth must be balanced against significant constraints. One of the biggest is adoption speed. Integrating AI into real-world organizations is complex. Data quality issues, regulatory requirements, legacy systems, and workforce training all slow implementation. Productivity gains may appear incrementally rather than all at once. This suggests that AI's economic impact could unfold over years rather than triggering an immediate surge. There is also the question of cost. AI systems are expensive to build and operate. Computing power, energy consumption, cybersecurity, and skilled personnel add to the expense. While AI can reduce certain costs, it can introduce new ones. For growth to be explosive rather than neutral, AI must generate value that clearly exceeds these added costs across the economy. Labor dynamics further complicate the picture. While AI can boost productivity, it can also disrupt job roles. If workers need time to reskill or transition, short-term frictions could offset some productivity gains. Economic growth depends not just on output, but on how smoothly labor markets adjust. A slower adjustment could limit how quickly AI-driven gains show up in headline growth figures. Distribution of benefits is another critical factor. Explosive growth at the national level requires broad-based adoption. If AI benefits are concentrated in a small number of large firms or sectors, overall growth may improve modestly, but inequality could rise and spillover effects could be limited. Widespread productivity gains across small and mid-sized businesses are more likely to drive sustained economic expansion. Policy and regulation will also influence outcomes. Supportive policies around infrastructure, education, and competition can accelerate AI's impact. Uncertainty or restrictive regulation could slow adoption. At the same time, guardrails around data use, security, and fairness are necessary to maintain trust. How well policymakers balance innovation with oversight will shape the pace of economic impact. Historical comparisons offer useful perspective. Past transformative technologies did not produce immediate, uniform growth. The benefits of electricity and computing took years to fully materialize as businesses reorganized around them. AI may follow a similar path, with early excitement followed by a period of adjustment before productivity gains become more visible in economic data. Another factor to consider is how AI interacts with existing economic conditions. High interest rates, supply chain constraints, and geopolitical uncertainty can dampen investment and slow diffusion. AI may improve long-term potential, but short-term macro conditions still matter. Explosive growth is more likely if AI adoption coincides with stable financial conditions and strong business confidence. So could AI trigger explosive growth in the U.S. economy? The potential is there, but it is not automatic. AI has the characteristics of a general-purpose technology capable of affecting many sectors at once. That gives it more growth potential than narrow innovations. But realizing that potential depends on execution, integration, workforce adaptation, and policy alignment. In the near term, AI is more likely to raise the economy's growth ceiling than to cause an immediate breakout. It can increase efficiency, support innovation, and help offset demographic challenges. Over time, as adoption deepens and systems mature, those gains could compound into stronger overall growth. The most realistic outcome is not a sudden explosion, but a sustained acceleration. AI may not transform the economy overnight, but it could reshape the trajectory of U.S. growth over the next decade. If that happens, historians may look back on this period as the beginning of a profound shift, even if it felt gradual while it was happening.